Welcome back, everyone, to Vox Markets. My name is Paul Hill, and by popular demand, I am delighted again to be able to speak to Jamie Constable of Singers, one of the UK's finest capital markets experts. So welcome, Jamie.
Hello, Paul. Good to be on again.
Yeah, well, happy New Year. And we've had a really sort of sharp steepening of the US yield curve and also gilts, with now treasuries 10-year around about sort of 1.9%, and I think gilts are about 1.2% when I looked this morning. What's your sort of outlook for financials into 2022? Because they seem to have been bucking the trend.
It has to be positive for financials. The yield curve steepening and interest rates going up is good news, because margins will expand. And of course, for the last 12 years of free money, they haven't been able to make much money on the net interest income side of their P&L. So now they will. We've already seen a little bit. There's been a bit in the press having a go at the banks for widening their margin, but I don't think you can blame them, because they haven't had that margin for years. So for financials, it's good. Rising rates, they're not going to go sky high. They're going to go up, though. Is good news for the financials, starting at the FTSE 100 with the banks, but then it will move down through the other to other companies as well, like the wealth managers, the Mattioli Woods of this world, Curtis Banks, who obviously are SIP managers. It's all good news, because higher rates means wider margins and making some money, rather than, if you think about it, last year we were talking about a number of European countries 10-year yields being negative. This morning, you mentioned yields. No European country has a negative 10-year yield net. Even Germany has gone positive this morning. It's only 0.005%, but it's positive. Now that's kind of a seminal moment, really. That's a big, big change.
And what point, when sort of interest rates go, not interest rates, but if yields increase or steepen so much, at what point does that become negative for the economy, and then sort of like returns or reverses through to the banks in terms of credit quality? At what point do you get that to be a real issue? Is it a lot higher, basically?
It's a lot higher. It has to go a long way. You just have to look back to where we've come from, and balance sheets now are relatively solid. Look, if you look at the UK economy, and we're interested in the UK here particularly, are we going to see unemployment in the UK this year? No. I mean, arguably, we had the data yesterday. UK employment is now ahead of where it was pre-pandemic. The unemployment rate is right back down in the UK to, I'm going to try and find the number now, 4.1%. 3.9 in the US. I mean, arguably, we could argue we're at full employment. I don't see unemployment coming through. What hits credit quality is unemployment and people not being able to pay. We've got the largest number of vacancies we've ever had in the UK, at over 1.2 million, and wages are going up. I don't see in that environment where credit quality is going to come under pressure. So yes, I think we will have points in the year, this year in particular, and maybe more for 2023, where people will worry that the central banks have tightened by too much, but we're a long way from that being a problem for companies and for credit quality.
And on the other side of the coin, then, where there is a bit of a pressure point, and has been, is in all things technology, particularly sort of like the Cathy Wood style ARC Innovation Fund stocks out in the States. And what you sort of, I mean, we've had a big correction in that area. And is it a case of staying away, or is it buy the dips? I mean, we as much as buy the dips, because you've got, well, as evidenced by Microsoft's purchase of Activision only yesterday for about, I think it was about $68 billion or something like that. So what's your view, sort of like with technology and software?
I think what we've got happening at the moment is, as yields rise, discount rates rise. So those future earnings are being discounted back at a higher rate. So the bottom line is they're worth less if you're valuing a company like that. I think it's fair to say, and I think this is more of a US picture rather than a UK picture, valuations got too stretched, particularly for loss-making companies that weren't making any money, and they got too far stretched. It's not so much a problem in the UK. But for highly rated stocks, when the discount rate goes up, i.e. yields rise, it's a headwind. But But you have to look at the companies in step one by one. If they're in a secular growth market, they're growing strongly, then rating, as long as the rating isn't too extreme, then they should still perform. Let's put it this way. If you're on 30 times, say, and you're growing at 30%, then yes, that rating is coming down pretty rapidly. So I think you have to, it's horses for courses on this. I think that there are headwinds for technology this year. We can't move away from that. There's headlines for technology. There's headwinds for kind of loss-making companies. But if you're in a secular growth area, they are stocks you want to hold for the long term. But you do need to know that this year there will be some headwinds that you will have to address.
Any particular names at all, Jamie?
What, within the tech?
Yeah.
Well, I think there's interesting names. I mean, positive. You've got to be positive on travel and leisure and opening up of economies again. So on the tech names, you've got companies like Accesso, which basically do the parks, the passes for parks. Well, they should have good following. With opening up, and the people like I don't know, Legoland or whatever it might be, the water parks in the US all opening up again. They've got a following. They've got a positive trend coming through there. So that's an interesting company that you can look at.
That's Steve Brown, the CEO, isn't he?
Yeah. It has to be on a case-by-case basis.
Yeah.
I do feel, I worry about stocks that were massive beneficiaries of the pandemic and lockdown. And on that front, I'm thinking stocks like maybe a Deliveroo's and Just Eats, and in the US, Pelotons and things like that, where they haven't made money during the lockdown. And then looking forward, if they haven't made money then, how can they make money going forward? And their cost of capital is arguably going up now. So I think those companies have got more, it's more difficult for those type of companies.
Yeah, my sort of preferred play is actually combining financials and technology with a reasonable valuation. And I own and I have done as a company called Equals, which is a fintech provider that does all things sort of like international payments and Forex. And they've gone through a fantastic sort of like transformation over the last 18 months from sort of a B2C platform into a B2B platform. And they had a trading update post Christmas, and they said Q4 like-for-like revenue was almost double year on year. And if you strip out a one-off transaction they did, is still up 70% like for like and 28% or something like that on a sequential basis quarter on quarter. And they're now running at about £1 million just over per week in turnover. And of course, as you know, in payments, it's all dropped through to the bottom line. And they've got a great following. So the shares have done well, but I mean, I think they're trading at just south of 80p at the moment, but I still have a fair value of over £1.20 and 25 on them. And I think if people are looking for case by case stocks, this one is in such a very strong position and should do well also next year or this year when people go abroad for on their holidays. But that's just really jammed tomorrow. It isn't baked into my forecasts. And the like-for-like growth of that business is just fabulous. Now, just turning to all things emerging markets, what about China's prospects? Because I did see it came out with some pretty weak Q4 GDP data at about 4%, which I think is the slowest it's been for years.
It is. Yeah, it is. And I think it's quite interesting looking at China this year, because while the rest of the world is arguably going to be tightening policy, and we've already seen that in other emerging markets, in Mexico, Poland, Russia, they've all raised interest rates and go move on for many more than that. China's going to be moving in the opposite direction. So last week they cut the two-year rate by 10 basis points, did a 0.5% cut in rates before Christmas. They're going to be cutting rates. So, I mean, within China, you've got a big issue at the moment is, of course, they've got their zero COVID policy. Now, I think it's pretty clear that with Omicron, zero COVID doesn't work. You're going to get it anyway. Just look at Australia, for example, 100,000 cases a day, whatever. If they're going to follow their zero COVID policy in China, that's a big problem, because you're going to see industries shut down again and supply chain issues prolonged through Q1. Why they're doing it at the moment, of course, is they've got the Winter Olympics, which they don't want to have any problems with that. And you've got the Lunar New Year holiday coming up as well. So I think with China, you're going to get, and what does it mean? What does it mean for investment? That's the key thing here. China's going to be cutting. and stimulating their economy, that's good news for certain sectors of the economy, particularly for commodities. I don't see commodity prices coming back. So metals, and the other driver for that, of course, is the electrification of the world, electrification of the global economy. I mean, that's what's happening. It's going to continue to happen. Copper, we've got EV driving nickel, all of those different metals. Look at the oil price. You've got no one drilling new wells. So the oil price is knocking on $90 now. That all feeds into inflation, of course. So yeah, you've got China stimulating. That means that for inflation, I don't see it coming back massively too rapidly. It'll probably peak in the spring. And then that's good news for certain sectors of the economy.
So how do you? So if you're saying you should ride the tiger this year, exactly in China, do you play that through local sort of 8 shares in funds, or do you play that through the big miners and oil companies?
Well, Chinese market, arguably, yeah. I mean, if you're doing kind of macro global investing, you want to buy a market when it's bombed out, don't you? The problem you've got with China, of course, is you've got Xi and what his policies is of kind of democratizing wealth, as it were. Now, and he's hit a number of sectors: technology, education, and on. He's hit these, gaming. He's hit these sectors hard. So you're investing in a market where you've got political risk, which is troublesome. So the UK-based investor, how do you play it? Well, commodity stocks is a great way of playing it. Great yields. Anglos, Rios, et cetera. I mean, all the ones down. It's a great way of playing it. But yeah, you could buy a China fund as well. I mean, buy a market when it's bombed out. It's always in macro investing that works. China's bombed out. Probably a good time to have a look at it, because it's still going to grow. It's not going to grow like it grew before, but they're going to be stimulating the economy, and that should be good news.
Equally, what about just moving sort of the base to all things healthcare? We've had massive M&A over the weekend, or speculation with Unilever potentially buying GSK's OTC consumer healthcare business, etc. What's your sort of view for all things healthcare? Because that still really hasn't moved a great deal, even though now it's got very long-term secular tailwinds behind it.
Totally. It's got the secular tailwinds, but it's also got the pandemic tailwind as well. So you're going to have bounce back as, I know, we've seen a few companies recently saying that elective surgeries come under a bit of pressure again over the Christmas and into Q1, because of course the hospitals are busy again. But you're going to have the bounce back from that. And then you've got the whole catch up that's got to come through from all the elective surgery that hasn't happened. So you've got great trends there on that side. So yeah, we remain positive on that sector in terms of what companies can do, whether it's a Yourgene, whether it's AMS or whatever it might be, different companies with that there. And again, it's a very company specific sector there. You have to look at what their exposures are. Even a company like Volex, they're a big supplier to Philips in terms of the MRI scanners. What a hospital is going to need going forwards? They're going to need more equipment. And the order books are already going up. I know Philips had a profit warning the other week. Why did Philips warn? It was more specific. It was to do with some inhaler device, which is a consumer device, where they've got problems. And they said that yes, they're having a few delays, which is not new news, getting into the hospitals to put the new equipment in. But orders of the new equipment is going up. So yes, the drivers are there. You're going to need more MRI scanners going in, et cetera, then that is going to be positive for that whole healthcare dynamic. We're not, let's be blunt. Are we going to spend less on healthcare than we did pre-pandemic or more? It's more, isn't it?
We are already, aren't we?
it's going to be more. So finding companies that have exposure to that, like a Volex and others, is a good space to look for. Some of those, of course, are loss making at the moment. I'm thinking more the biotechs and stuff like that. So again, do bear in mind on those that investing now, average your way in, because those stocks will still remain under a bit of pressure because of the higher discount rate looking forward.
I would point investors to have a look at 2 companies in particular, which are very stock specific in this area. We've got SourceBio, which basically has a sort of like its base core business is cellular pathology, generic sequencing, and sort of like drugs, cold storage, etc. And that's all now back to pre-pandemic levels. And with that the elective procedures coming through, the 6 million patient backlog, then that should continue for years ahead, sort of good strong double-digit growth. And then it's obviously got this infectious disease testing business, which is largely COVID related, and that's PCR really testing, and has done really well obviously this year. They've got a big cash balance, and they're looking for for M&A, so, and that one's cheap. And Christopher Mills is a big shareholder, and he's positive on the stock as well. So that's something that people should have a look for. And then the other one,
there's two others in that space. While you're talking about that, I mean, they announced a deal yesterday. EKF and between themselves, EKF and Yourgene are two other interesting companies in that space as well.
Yeah.
So, and your second, sorry.
Another one, which is actually, I think, just by coincidence, is a Singer stock, is Venture Life, that has been through the mill, that does OTC healthcare, consumer healthcare products, and I think the shares were over £1 about sort of like June last year, and they sort of like fell to below 30p pre-Christmas. They've bounced since then because they were just well oversold. And I spoke to the CEO, Jerry Randall, last week. And yes, they still have problems from some sort of COVID related, whether that's product destocking, whether that's sort of China still hasn't really got back, and likewise with sort of input cost inflation. But most of those should be ironed out in 2022. And if you actually believe, which I do, Singer's estimates for 2022, which is less than the other house broker of EBITDA of about 8 million or 8.1 million, then they're trading at sort of only less than 8 times EBITDA. And if you look at what Unilever is about to pay for the similar sort of OTC business, which is 20 times at least at EBITDA, and these things traded at about sort of like 15 times, then they're on a really cheap value for a defensive portfolio of stocks with a reasonably solid balance sheet on an M&A, and they've got a lot of self-help measures, i.e. internal control that they can do this, or internal impact they can do this year. So that would be something. If they can, to me, if I've run the numbers, and if they can turn that round, which I think Jerry will be able to.
It's all about delivery for that stock.
It is, yeah.
It's about delivery of those numbers. I think you've hit a nail on the head there, really. That I think this year, I mean, the last few years of free money has been about momentum. Buying momentum has done people well, to almost to the extent that you've had the kind of nifty-50 kind of thing. You get big, you get bigger, and you keep going up, and other stocks just get left behind because they're not in that nifty-50. Now, I think this year is really going to be about, and I think value is a much misused term. I think I much prefer kind of GARP kind of. It's about buying stocks at the right price, which sounds a truism to be honest, but it's growth at the right, buying growth at the reasonable price. GARP is what this year is going to be all about. Your in price being the right one, and not just solely following momentum. And that's what you get, because if we are coming to the end of free money, which arguably I would say we are in 2022, we've had 12 years of free money, maybe longer. Some of the old metrics that we used to use to value stocks and look at markets are going to come back in. So it's all very much, getting your entry point right, paying the right price for a stock, rather than just following the momentum, I think is key looking forward.
Yeah, well, I mean, the OTC sort of sector, the industry is growing at least at sort of like, mid-single digits, sort of 5 or 6%, given all the, aging demographics and sort of like requirement to push healthcare out into the community where people pay. But actually, when I spoke to Jerry, he's looking at organic growth, like for like, excluding M&A, of around about 10% for his niche type of portfolio and products. And then with M&A would be on top as well. So when you talk about GARP, actually they're doing that potential, that business, if you can get that ship sort of turned around and singing, then you'll get really cheap. I mean, not only is it cheap in compared to the industry, i.e. less than 8 times EBITDA compared to 20 times EBITDA, which is what Unilever is paying for the GSK or maybe paying, but actually it's really cheap when you look at it, that they are expanding on an organic basis at double the market rate. So again, it's an interesting sort of turnaround play that seems to be sort of taking shape, because they've also just appointed their new Chinese distributor, which I think came through. Yeah, which has been a problem area for them. So
it didn't work. The old one didn't work, so getting a new one on board is very important.
Well, I think we like that strategy, don't we?
Exactly, kick them out and bring a new one in. Yeah. I think the other things this year I'm feeling pretty positive about Capex. I think really, because the big drivers, stocks that are driven by Capex, because the big drivers this year, you've got reshoring, nearshoring, you've got supply chain. There's a lot of work going on about companies, and also if rates go positive, you're going to get positive carry on things. I think some of those zombie companies that have been run for cash will end up going bust then, because rates are going up. The banks will feel comfortable. It's a bit of a sad thing to say, but the banks will feel comfortable putting those companies into receivership now. They don't want to run them for cash forever. And that increases the return on capital for everybody. So the incentive to invest goes up then. So I think Capex is going to be quite a trend this year. And arguably, we've seen a decade of suppressed Capex going on globally, apart from certain sectors, like data centers or things like that. So I think we will see some of those industrial stocks that, let's be honest, people haven't looked at for years, are going to become back into favor again. So that's an interesting area of the market.
And which ones? Things like Avingtrans and people like that.
Well, I think Avingtrans will be good, but again, Volex are driven by that. But some of the old kind of metal basher type companies, Vesuvius. I'm thinking about automotive will be good as well. I mean, that's not so much Capex, but you're going to get bounced back from the hit from chip shortages. But Morgan Advanced is a sport. Again, Capex led. They're late cycle type stocks where people are going to be spending money. But again, it's about paying the right price for those stocks. Spirax, Sarco, brilliant stock, absolutely superb stock in the FTSE.
Which one? Sorry,
Spirax, Sarco, brilliant steam systems that go into industry everywhere. But it started the year on 47 times. It's fallen 10%. It's still on 43 times. Is that GARP? It's a brilliant company, but it's not, is it? You've got to buy it at the right price. So it's all about that, and looking for the right stocks that meet those criteria.
Yeah, I would certainly underline that. Yes, that sector should do well, but you've got to choose effectively companies with pricing power, with IPR, totally. because if you get basically a business that is effectively just a straight metal basher without any pricing power, and also you choose an industry maybe like the automotive, so the traditional automotive, not the EV side, but a traditional automotive company with still industry secular sort of like headwinds, i.e. too much capacity that needs to be taken out, particularly like your Peugeots and your Fiats and these kind of guys, then you're going to struggle. So it really is choosing the right spots in the whole industrial area.
You've got to be, I mean, it's an interesting at the moment, because that is an industry and that is arguably moving to secular growth, because you're going to have to refleet the world, aren't you, if you move to EV. So it's fun, no surprise that we've seen some of the motor distributors taking themselves private, because they can see quite a nice outlook from here, as everyone's going to have to get rid of their petrol or their diesel cars. So there's quite a strong outlook for that kind of area. But if you're on the right programs, and let's be honest, what's going to happen to EV volumes? They're going up by arguably 25% minimum per annum. Then you're in a great spot, aren't you? Because you're going to see your volumes increasing. And there's a real weird dynamic going on in autos, because if you went to buy a new car, you always got a discount, didn't you? You won't get one today if you go and try and buy a new car. All the motor manufacturers are selling their cars at list price and making big margins. So some of that pressure, I agree with you, you don't want to be in. You will see pressure come on because they're the best in the world at putting pressure on their suppliers, the automotive manufacturers, as volumes grow. But at this point in time, you've got quite a very nice dynamic coming through for that sector in terms of what's happening. So I think there's some, your TI fluids, companies like that, they should be in a great spot going forward certainly for 2022 against 2021. But again, and it's about paying the right price, and you hit the nail on the head on margins and pricing power. In an inflationary environment, which we are in, If you can't raise your prices, your margins are coming down. And the other side of that, and now we've got, has it or hasn't it is a big question, but are we moving into a wage price spiral? I mean, that's a big question, but it's looking more like we are.
Well, that's a great place to go. So what about the health of the consumer? Because I know you've been negative on that one, but I mean, I was watching the BBC News only last night.
Yeah, you've got to get depressed. That's a good way of doing it.
Exactly. Yeah. And they were talking to some refuse collectors in Bournemouth who frankly went on strike and said they wanted a 20% pay rise, and they finally agreed at 11% with the council. Now, 11% with the council, that sets a bit of a precedent in terms of public sector, etc. So what's your sort of view? I mean, I'm guessing it's choose your right spots.
Wages are going up. I mean, and then let's be honest, people are changing. The Great Resignation, which has come out of the States, it's not so much resignation. It is some people are withdrawing from the job force. It's people are moving because they can get more pay moving to another job. And as we said earlier, there's 1.2 million vacancies in the UK at the moment. People can leave one job and go to another one and get a pay rise. And that's what they're doing because that job market is very fluid. So yeah, pay rises are happening. 11%, I hadn't heard that 11% one, but I mean,
I know.
The consumer's getting squeezed at the moment. We can't move away from the fact that the consumer's getting squeezed. UK inflation's 5.4. Wage settlements, we had them out yesterday, were less than that, but they're moving up. They're definitely moving up. And it's if we're at a point of change in the markets, it's all very much, but the question is, are you looking backwards or are you looking forwards? And it's very interesting to see how stocks are moving. Case in point, Wetherspoons today. It was a pretty downbeat statement, let's be honest, and unusual. He had a massive go at government, of course, because he loves to, Tim. So that was interesting. But the shares are up, well, they were when I last looked. So it's about looking forwards, looking back. Looking forwards, the economy is going to reopen again. You're going to get more stimulus to the UK economy when the economy reopens, because people are going to start going back to work. They're going to go back to city centres again. So you're going to get that stimulus coming through. And then wage growth's going up. But you can't get away from the fact that the consumer is going to be squeezed this year. I mean, come April, it's a question of how much energy prices are going to go up, isn't it? It all depends on government policy there, so who knows what they're going to do. But wages are going to go up. Sorry, energy prices are going to go up. Your point about 11% for a refuse worker, well, that means your council tax is going to have to go up quite a bit as well, isn't it?
Yeah, so, no, you're right. So we're saying you got to pick your right spots in sort of consumer. I mean, we had Acrol, who make sort of like distributor own, distributor own toilet tissue, and they had an absolute mare because they can't pass on their price inflation. But equally, you had sort of like a trading update from TGI Fridays, Hostball, the other day, saying that it was seeing, it was maintaining its prices. So is it really sort of like, again, choose your right spots in the consumer area where there is strength or where there is still a big, strong reopening play?
Well, I think reopening play helps. So that's number one for Hostball. Secondly, pricing power is key. And people are going to want to go out. It's like holidays. Are people price sensitive this summer on going on overseas holiday?
No.
I would argue they're not. People are going to pay up. The airlines are going to have, so it's back to that kind of BMW type question. Is how are they selling their cars at the moment? They're selling them at full margin. How are you going to sell your holiday? You're going to sell it at full margin. If people want to go to the pub, there's a little kind of niggle on the leisure side, UK leisure, because of course last year you had the staycation. So come the summer, the comps are going to be quite tough. But I'm more kind of inclined for the holiday companies we spoke about On the Beach last time, where Jet2, EasyJet, those guys should have a really good summer. And there's a second derivative from that is that you actually can talking about Capex, get much more positive on the aerospace suppliers like a Senior and things like that, because if the airlines are getting full margin, they're selling their flight, they're going to start reordering it, reigniting those orders again. And then what's going to happen to companies like Senior? Well, they're going to start seeing orders coming back in. And like the auto sector, volumes are going to go up. And the companies are going to announce upgrades. Market will like that. But again, it's all about pricing power. You've got to have, in an inflationary environment, if you haven't got pricing power, and you've got wage growth as well, input price increases as well, you can't price it on, your margins come down. That points to multiple compression, doesn't it, on terms of the rating?
Yeah, well, I was speaking, just as a quick data point, I was speaking to Chris Watlin of Longview Economics only a few days ago, and he's doing a catch-up trade on his skiing holidays, so he's doing 3 this year rather than.
I've just booked one, and I looked at the price and I went, blimmin' heck, sod it. I'm paying it. I haven't been for 2 years.
Yeah, exactly. So people are going to go, aren't they? No doubt about it. And talking about sort of pricing power, I mean, one area that I think I might have mentioned to you that I think that should do really well, that's been thrown out with the bathwater, is Michelmersh brick, because it does premium bricks, which are aesthetic. People like to, basically have the houses and the buildings and infrastructure looking good. It's trading at less than 8 times EBITDA. Stocks like this will trade should be traded at over 10 times the EBITDA for next year. The low estimates are out there for 2022 anyway, so the bar's not that high, and they've basically hedged out all their energy costs throughout 2022 into 2023. And they're pretty prudent, and they'll see strong pricing power this year, which will come through after the rollout of their long-term sort of contracts. And the housing market in the repair and maintenance markets are still strong. So that would be one I would throw out as a good, solid, long-term sort of play. The shares are about 125, 130. I mean, I have a fair value over 250 for them. So I think there's plenty of scope over a 5-year view, 3 to 5 year view.
I think that's the thing, isn't it? You're tucking those away. And you're not buying them on a 5-minute view.
No.
You're buying, this company is going to be worth a lot more in 3 years' time than it is now. Yeah. It might, it might be a bit trickier this year, but you're tucking them away now, and that's what investment's about, isn't it? Really, and you put your money in, and you're gonna have you can make money. You don't know when you're going to make that money, particularly, especially from private client investing, but it's worth considerably more than the current share price is discounting.
Yeah,
other companies I might mention. I mean, the other thing that's going to, obviously, the greening of the global economy, talking about Capex, that's going to be a huge driver. You saw earlier in the week that in Scotland, they just licensed a load of sea for more wind power. We've got a little company called Tekmar, which is interesting on that front. They do the protection systems that go in for the cables going into these.
That's Alistair and Derek, isn't it?
Yeah. I think that company could be quite interesting looking forward. So that's
agreed. Yeah, agreed.
Yes. That's an interesting one there. I'd have a look at that. The other thing we need to remember, and you talked about bricks there, distributors in an inflationary environment, distributors is a great place to be. And you saw that with Brickability's numbers the other day as well. Why distributors are good is, of course, in an inflationary environment, you buy your stock and you sell it 2 months later and the price has gone up. So not only do you get volume growth, you get price increase as well. So yeah, agree.
Another one where you have sort of best of breed. And I think that is that you've got either pricing power or you've got basically best of breed. And I would say with the consumer stay, online is a secular tailwind. Plus, if you've got a company effectively well beating the market, then stick with those winners. And I would point out, newly listed only about sort of 4 or 5 months ago, is called Marks Electricals, which basically is an online. It's an online retailer of all things, sort of like domestic appliances, cookers, fridges, freezers, which you think is not actually exciting. But when you look at the numbers, you will be very excited because, I mean, over Christmas, they did over 25% like for like against tough comparisons from last year. And then you look at the industry, which declined for, electricals, that went down over Christmas by 10%. So they outperformed the rest of the industry by 35%. And then you had Currys, who had a trading update, who are the biggest sort of like, animal in
the old Dixons.
The old Dixons, but Currys, sort of the white goods man, and they were down 6% in the UK. So they've had huge. They're basically, Marks Electrical is best of breed, best of class. They're knocking the ball out the park. They have a small market share, about 1.5% of the UK. But actually, the CEO and founder is really entrepreneurial. I don't know if you ever met him, but I've
met him.
Mark Smith.
Very impressive guy.
Yes, Mark Smithson. He's hoping to take that to a market share of 10%. And if you run that through, you get a share price of over 5 years of about £6, £6.40, I can calculate. And if you go half of that, you still get over £3.50. And the shares are currently about 130. So again, if you take a long-term view, you want to move, in my view, for consumer stocks, you want to move move into online secular trends, which is obviously the the internet side of it, plus best of breed, and don't get lost in the noise by looking at elsewhere for value, when essentially you stick with the companies that are really doing well. I mean, their Trustpilot score is 4.8. I've never seen anything quite so high.
They're superb. They're super. Next day delivery, stock. Yeah, it's they've got very good relationships with the suppliers. That's the key part of that.
And the whole digital strategy that they're adopting now is really still at a nascent level, and that will only get better and deeper. And their customer base is very loyal. So again, stick. It's a case by case, isn't it? I think.
It is. I think that's very key now. I mean, before momentum really did work well for a lot of stocks. Now, as we said, it's about buying stocks at the right price, tucking them away, and then you will. There'll be more volatility this year. The market's it's not going to be straight line as rates rise. It's often actually it's the worry about the first rate rise that tends to worry people more. Often when the rate rises start, so when the US finally starts, because obviously the US being the global, drives the global markets. When the US finally starts, you might see a bit of stability return then, because it'd be kind of great. They've done it. Oh right, they've moved. They started to move.
Okay, so we'll end on what's the $64 million question. When will the Fed hike rates, and by how much?
Well, they can hike next week, but everyone believes they won't because of the meeting next week, because obviously you've got Omicron going around and stuff like that. It's 100. The futures tell you it's 100% they're going to hike March. I think there's chance now they might do 50 basis points in March.
Wow. And what about the Bank of England? When's that going?
I think after the inflation data today, you got 100% that they're going to do another quarter on is it February the 3rd? I think the next meeting, February 3rd, I think. So I think it's 100%. You get another quarter then to take it to 0.5%. Then I think they'll pause for a little bit. I think they'll pause for a bit then and see what happens with the numbers from here. But you've got to think about the UK and the US. The economy. I mean, let's just read the numbers out again. I mean, US, you've got inflation at 7.1%. 7.1%. You've got interest rates at 10 basis points, 0.1%. You've got unemployment at 3.9%. And the Fed is still buying bonds. I'm going to repeat that because it's just they're still buying bonds. They're tapering, but they're still buying bonds. I mean, that's just loony land, isn't it? It's just loony land. What are they doing? And they haven't raised rates yet. So that's what the market, and with the US market, what the market's worrying about is that the Fed behind the curve and what's going on. And that moves, and obviously what happens in the States has ripples for the rest of the world as well. But interestingly, the UK market's outperforming quite nicely at the moment. As we said, inflation play, UK is a good inflation play because the financials and commodities and the FTSE, and the UK market is much, much cheaper than the rest of the world.
I'm going to give you a one single yes/no answer, okay? By the time we chat in a month's time, will the 10-year Treasury, it's currently at 1.9, be above 2%? Yes or no, Jamie?
Yes.
Okay, yeah, that makes sense.
We said it last year and it didn't happen.
All right.
This year, yes, it's going to happen.
No, next month.
Next month, yes.
Okay,
yes.
Yeah. Well, that's okay. Brilliant. Well, we'll close it on there for a bit of definitive answer for everybody, because I totally agree with Jamie, and we'll look forward to see whether it is or not in it's 4 weeks' time. So, thanks very much for your time, Jamie, and look forward to speaking to you again.
Cheers.